So how does this market actually trade? As in, how does it code that particular differential? As I said, it is a difference between the rate applicable for 31st August and the rate applicable for spot date, which is 18 July. So how does it actually trade in the market? Right? That is what we will discuss now. Now, if you want to buy USD against INR, right? Now, what do? I will do this transaction. First, I'll write the transaction and you can see how this transaction actually is equating to what you want to do. Let's divide this into two parts. First, buy USD against INR value. Rather, one more thing is, in the market, the terminology, sometimes people use this terminology. Instead of saying for a particular date, they will say value that date. So in this case, instead of saying USD INR for 18 July 22, instead of saying this, they will say buy USD against INR value 18th July 22, which means for settlement value 18 July 22. Right? Now let's say this USD INR I want to buy is for 1 million USD. Right? And I will also write these rates here. The spot rate for buying, as I discussed last time, there is a bid offer. Now the bid offers, you know that to buy dollars against rupees, you have to use the offer rate, not the bid rate. Right? This offer rate, let's say, is 79.80. Right? Is the rate for buying dollars value spot on the spot date. This is the spot rate. Now, what I will do here is that first I wrote this transaction, buy USD against INR value 18 July 22. Now, obviously, this is not what you want to do. You want to do it for 31st August. So what you do again, you do another step. What is the step? Sell USD against INR value 18 July 22, right? Then you will buy USD against INR value 31st August 22. Sorry. Okay. So look at this transaction. You have one transaction, one leg, which is you are buying dollars value 18 July 22. You're buying dollars. But you are doing another transaction here. Not that you are doing. This is the back end of what bank actually does. The second transaction is sell USD against INR value 18 July 22, right? And buy USD against INR 18 value 31st August 22. Now look at this transaction. You are selling dollars against rupees on the spot date, and you're buying dollars against rupees, the same amount of dollars against rupees on 31st August 22. Effectively, what you're doing is you are selling today, or rather spot date, and you're buying back the same dollars later, right? This is a swap. You're swapping the dollars for today. Instead of today, you're swapping them to a future date. So what happens is this particular transaction itself is traded in the forward market. The forward market does not trade any other transaction. It trades this particular transaction. It sells for today, or rather value spot, and buys for future. It buys for today, sells for future, whatever it is, sell, buy. So effectively, you buy today, sell in the future, or you sell today, buy in the future. This is the transaction that happens in the market. This transaction is what is called an FX swap. As the name suggests, it's a swap transaction, and it is swapping today's dollars for future dollars, or it is swapping, you're buying today instead of future, or selling today instead of future. So basically, this is a swap transaction. That's why the name called FX swap. You're swapping Forex, right? This is the actual transaction that happens in the forward market, and the spot market is what it is. So when you as a user, or when you as a company or an individual, you go to a bank, the bank will do two transactions for you at the back end. One, they will buy you buy dollars against USD, and you sell dollars against USD. So what happens in reality is this number one leg, buy dollars, will cancel off with the sell dollars for the spot date. And what remains is the buy USD against INR for value 31st August 22. So the spot rate leg will be cancelling off the sell USD leg, cancels the spot rate leg, and what remains is the buy dollar leg, right? So I will now demonstrate it with the numbers so you'll understand it actually better. Say, let me write the numbers here. So 18th July 22. This is the date, right? This is the date. Right? 18 July 22. Then you are buying. I'm writing it from your perspective, right? Your perspective. That means you have gone to a bank and you are doing this, right? So this is from your perspective. You're buying. This is buying, right? Instead of writing buy, I will write plus. Plus means you're buying. Minus means you are selling, right? So let's say US dollars and INR. You are buying dollars, right? So this is basically 18th July. So what are you doing? Your spot transaction leg. What are you doing? You are buying plus $1. Let's assume $1 you are buying. For simplicity's sake, instead of 1 million, I'm writing $1, right? And when you buy dollar, you will pay how much? You will pay minus 79.8 rupees. You will pay that because that is what you are going to give to the bank. If you just did a spot transaction on 18 July settlement, this is what is going to happen. Now, but the FX swap, the second leg, the second FX swap transaction is what here? You are buying, in this case, you are selling. So look at this, sell USD against INR value 18 July. So on 18 July, what is going to happen in the FX swap transaction? You will sell dollars, which is -1, and which means when you sell dollars, you will get equivalent amount of rupees on the spot date. Why is it spot date? The spot date because the first leg of the FX swap happens on the spot date, right? As per the transaction, you're selling for value 18 July and the rate is 79.8 rupees. You will basically get when you sell $1. This is the first leg of FX swap. Leg of FX swap. Now, once you do this, the next leg of FX swap is what? As in this transaction happens on the same day. It's just that I'm basically giving you leg by leg breakup. So the next leg will be what? 31st August 22, right? I have to buy USD against INR, right? Because I sold first leg of the FX swap was sell, right? You are selling. And the second leg is you're buying. So so your buying means the $1 will be positive. Now, what is the rate at which you will buy? The rate is therefore for the FX swap, you are doing sell on the one leg and buy on the other leg. So the difference in the rates of these two legs is the forward premium. The forward premium is nothing but the difference, right? The difference between the near leg, which is the sell leg, 18 July 22 leg, and the far leg, 31st August 22 leg, the buy leg. The difference is the forward premium. Now, what is the forward premium difference? In this example, let's assume the forward premium is 20 paisa or 0.02 paisa, 0.2 rupee. Forward premium is 0.2. So what will happen is the 0.2 will have to reflect here, right? So the rate at which you will buy dollars for the future in the FX swap leg is 79.8 plus 20 paisa, which is 80.00. So this is the second leg of FX swap. So when you add up all these numbers, what are you going to get? What is the final outcome? The final outcome is these two cancel out, right? These two cancel out completely. It becomes zero cash flows. What is left is $1 against 80 at the end of 31st August 22, right? This is how the forward markets actually trade. They don't trade spot. Spot is a separate market. What is traded is the first leg of FX swap. The FX swap transaction is what is traded in the market. So you buy or sell, vice versa, right? This is what happens. Now, in terms of terminology, this particular FX swap, sell near term, which is 18 July, and buy far term later, this particular transaction is what is called a sell buy swap. A sell buy swap means sell today, buy in the future rate. Similarly, the other will be obviously other transaction will be the opposite transaction will be buy sell, right? Buy sell. buy sell swap, sell buy swap. Right? In a sell buy swap, what is happening is you are ending up buying dollars for the future date. In a buy sell swap, you are buying dollars in the near term and selling dollars in the future. So this is how markets actually transact, right? This is the forward market. The forward market is also called in the interbank, the terminology, it's actually an FX swap market. It doesn't give you a rate, it gives you the difference. What is the difference? They agree on the difference. 20 paisa is the difference between the two dates. And then they transact the spot. They will say, okay, 79.8 today, 79.8 plus 20 paisa, 80.00 2 days later, 2 months later, or 31st August 22. So this is how they actually transact, right? This is an FX swap transaction. And the terminology is very simple. Sell buy or buy sell, near leg, far leg. This is the terminology, near leg, far leg, right? And as with any market, this particular FX swap market also has a bid offer, right? So if two traders are talking to each other in the forward FX swap market, right? They will say, okay, I want to do a sell buy swap with you, right? Or a buy sell swap with you. What is the rate? The other trader will quote for buy sell swap 18 paisa, for a sell buy swap 20 paisa. So they will actually have a bid offer. As with any market, even FX swap markets also has a bid offer. Buy sell swap, sell buy swap, right? The two FX opposite directions will have two separate rates like any other market. This is the way actually FX swap transactions get done. And I'm giving an example of dollar rupee, but this applies to every market. Spot market is separate. The forward market is FX swap market, which is separate. For that matter, even a cash term, cash spot, all of those transactions are also FX swaps, right? Here, I swapped from spot to future. In the cash spot or a term spot kind of a transactions, to get the cash rate and the term rate we discussed last time, you will do an FX swap from spot to cash. Same concept will apply, right? So this is basically what is the actual transaction which happen in the market. What you see in the screens as forward rates, as all of those are just the rates. When you actually deal with the bank, if you want directly a forward contract, the bank will give you a forward contract, right? But in backend, in the interbank market, this is what happens, that you have a separate spot trade and you have separate FX swap trade that happens in the market, right? So this is an important instrument, right? This is something we will, as a forward, when we go into future sessions, we'll discuss much more about how these are arrived at, what are the other terminologies related to them, right? Paying premium, receiving premium, all of those aspects we'll cover later. But for now, just understand the concept of an FX swap and how actually it gets traded in the market, and the concept of a sell buy and a buy sell.